Swayam Prabha. Digital India. Educated India.
We are with topic 3. Okay. We started money market. Now, today I really begin a complex instrument, commercial paper and what is that other thing you have seen? Commercial paper and certificate of deposit. Now, I get into something much more complex. So, today I begin slightly more complex money market instrument which government uses. It's a government instrument. Gilt-edged market instrument. Government uses to raise funds. This is called treasury bill. This is called treasury bill. So, I am going to talk about treasury bill. Silent, please. Treasury bill is also a finance bill. Do you understand the meaning of finance bill? These are the words you will get in books. Treasury bill is also a finance bill. Finance bill means it's a paper which is used to raise money, to borrow money. It's called a bill because this is the common terminology, but it's not a bill like you go to a store, you buy goods and you get a bill for payment. So, that kind of a bill is a real bill because the real bill carries some real transactions in good. Say a company purchases raw materials from a company in Tamil Nadu. A manufacturing company in Kanpur purchases some raw materials from a company in Tamil Nadu. Since Tamil Nadu is far away and there is a payment problem immediate, today it is not much of a problem. I will talk about this later. They create something called commercial bills. These bills are real bills because this is a real transaction. The goods will be shipped by road or by railways and they would arrive and there is this agreement has to be there for payment. These are called real bills, but finance bills are bills which are purely a monetary transaction. There is no real goods changing hands. Therefore, financial bills are different kind of bills. So, it's a finance bill. First thing to remember, just like CP and CD, but it is also a promissory note. It's also a promissory note. What is a promissory note? Is a paper on which something is written. We call loosely note the currency. But a promissory note is which promises to pay something, all right. So, which is our currency also, a note, promissory note, promises to pay you something. Treasury bill is also a promissory note. In simple words, it's like a bond. It promises you to pay some amount, say as an interest or whatever, and when it borrows money from you, and it has a maturity also. So, it's a usance promissory note also. So, it is just like a commercial paper and CD, except this is a government bill. So, it has enormous importance for a macroeconomy, for the money market. It's enormous importance. Because when government goes into a borrowing mode, it's not a company's borrowing mode. Company's borrowing mode is much smaller compared to when a government goes into a borrowing mode. And when government budgets are having deficits, They're usually thousands and lakhs of crores. All right. So a borrowing mode there using treasury bill to fund it, to finance it, is a big issue. It does influence the market, the interest rates, etc. It's very important. All right. So I'm going to go through slowly treasury bill. So it is usually the government bill, a finance bill, and a promissory note like CP. But interestingly enough, at least in India, I don't know about all other countries' practices. Some countries may have similar practices. After all, India was born after many countries. So India adopted many things from the Western countries. Our constitution was adopted from various Western democracies, the British Constitution, the American Constitution, etc. Our parliamentary system is very much borrowed from the British parliamentary system, the concepts, etc. Similarly, our central bank was designed after some other central bank, maybe Bank of England. Now, normally, not so much these days. For years, Central Bank of India used to take the responsibility of selling the Government of India's treasury bills. Government of India, its treasury bill, but the responsibility of selling it was with RBI. So RBI was acting like an underwriter for the government. So when a company sells shares, it doesn't directly go to you and me and knock on your door and sell shares. It appoints underwriters who take the responsibility of selling the shares. So RBI was acting like an underwriter for government bills for a long time, the treasury bills. Anyway, so I will go to all that. Now, historically, which is not anymore true, so far my understanding goes, there has been two types of treasury bills the Government of India has been selling. One called ad hoc treasury bills, ad hoc treasury bills. The other one is called ordinary or regular treasury bills. So there are two kinds of treasury bills the Government of India has been selling, and how it worked. Ad hoc means essentially what it implied was Government of India was selling it whenever it required funds. And what it did was simply what we call deficit financing in macroeconomics. Government doesn't have money, government doesn't have money in its account anywhere, either with RBI or with other banks. Government needs cash. I'm talking about the 60s and the 70s of Indian economy, or even 80s. What used to happen? Government needs funds, it would knock on RBI, say, here, le lo ad hoc bill. Means it is guaranteed by central government, and RBI would say, oh, what can I do? I'm your central bank. One of my job, which you will see in the next topic, is to serve you. Not like a commercial bank, which behaves the other way. I'm supposed to serve them, their behavior. But RBI, being central banks, central government's bank, first job is to serve central government. So what it used to do, okay, sir, we are accepting, say the finance minister knocks on them, phone calls them up. Ad hoc bill चले आए, कुछ पेपर लिखा है, इतना इतना अमाउंट, ठीक है? Okay, what RBI would do? Doesn't have cash, starts printing, hand them over. Now, if you go to a bank and say, I don't have cash in my account, give it to me, bank won't print and give it to you. But central bank can do that for the central government in particular. I do not know so much about state governments, they also sell treasury bills, but I do not know much about that interaction. Their ad hoc bills became notorious in some sense in India because they were sold anytime any amount central government wanted, and then sometimes RBI would say, oh, too much of printing going on. So, they would then take the responsibility that maybe 50% of the cash they would print and 50% they would go to state governments, semi-government departments, people like you and me, maybe foreign governments, all right, to get the money. So, it would act like an underwriter. One is like a financier, okay, and the other part was like an underwriter. Okay, I am going to try to sell this on your behalf to whoever is willing to buy them. Right now, famous US government treasury bills sold all over the world. Main investors are like China. देश के अंदर तो रुपया है नहीं. So, they are going to China etc. and buying them. Europe may be purchased nahi ho raha, Europe does not have funds. In fact, Europe is asking China to help them out. It is fascinating stuff going on in the Western world. Europe is asking China to help them out. USA is asking China to help them out. They are the main investors in treasury bills. Their own country, banks etc., how much they purchase, I do not know. But I have heard the largest investors are China. One of the largest investors is China. So, this is the ad hoc bill, and ad hoc bill had a very funny thing. It has no market related relationships. It had a fixed return, which either the central bank, the RBI, or RBI in concentration with the central government would fix it. No market determined. So, how would they fix it, you think? The discount rate or the interest rate? Very low. So, the interest burden of the government is low. They are short of cash. They want as much cash as possible from elsewhere. And when they fix the return, they had the power, they would fix it very low. It is not market determined. Okay? All right. In the market, it would have been very high, because how much of money existed in elsewhere in the economy to buy central government bills often on a regular basis. It was not possible. All right. And it was very low, and you won't believe me, the rate of interest was pegged. Pegged means fixed. It was pegged at 4.6% for a long time, decade after decade. 4.6%. Is it any decent return? In India, sometimes those days inflation rate went up to 25%, and the treasury bill interest rate was fixed at 4.6%. So, nobody was getting any return. Why government was doing it, you understand? Government did not have the financial standing to repay any decent interest. So, it was asking RBI, and RBI is like my step brother. I can ask him for help anytime, part of my family. And whether I pay him any interest rate, a decent interest rate, it really does not matter. Poor RBI sometimes got fed up with printing so much of notes, went to the market and tried to sell it. Otherwise, it is entirely upon them, because after all they look after monetary policy, and in macroeconomics, you know, if there is too much money chasing too few goods, what would happen? Prices would start shooting up, and in fact that used to happen. Inflation used to be notorious. Again, we are back into kind of a days and months of high inflation. It was not there for a long time. We are back to it. I don't know, some mismanagement going on, everybody is saying. The entire economy is getting mismanaged currently. Beginning with the government and the central bank, everything is getting mismanaged. So, we are back in very bad days, because every time anybody from the economy, like the private sector other than the government, giving an interview, including the other day NDTV was interviewing Narayan Murthy, Infosys ex-boss. And yesterday I saw there was a investment summit going on in West Bengal, and there are some industrialists speaking, just like us, with PowerPoints and all sorts of data, they are speaking. Oh, what they have to say is unbelievable. After a while I got so depressed that government is under functioning so much, and RBI is mismanaging the economy so much, I switched it off and went to some other thing. I say it's impossible to watch. All right. So, that used to be the case, ad hoc bills. On the other hand, ordinary and the regular treasury bills, these are like other country treasury bills also, like the Western countries, developed country treasury bills. These used to be sold through a market mechanism. What was the mechanism? The mechanism was they would call tender or put it through weekly auctions. Both are kind of market, because the buyers would come and bid, all right, and they would bid for the interest rate and also bid for the amount they want to buy. Together, government will take the lowest bid. Just like if you are going to construct a building, there are 10 contractors around, you ask for tender, and then they come in sealed envelopes, the quotations, and then in front of other people you open that and you select the lowest bidder. This is the thing. So, this has a market nature. This has a kind of a market dimension where market forces determine something. The ad hoc bill was government saying this much I want, this is the interest rate, and it was pegged for years. All right. So, either through tender or through auction, you know how auction happens. Auction is quick tender in some sense. Everybody gets together and everybody starts bidding. So, somebody said 7% and I want to buy this amount. Somebody says something else, all right, and I want to buy this amount. Government has already announced, say they need 10,000 crores. Somebody says I need 1,000 crore, I want to buy at this rate. Finally, through that bidding process, which is an auction, the job is done, all right, and there is an auctioneer with a hammer. You have seen bidding, like precious articles, paintings, etc. Auctioneer stands with a hammer and keeps on saying, and somebody raises a placard or a hand and says some amount. And finally, when it is decided, he puts the hammer down with a bang, with a huge noise, saying over. So, weekly auction they arranged, and tenders. Tenders take more time, it cannot be weekly, because tenders take months. You call a tender and you give them 10 days time to submit the tenders, then you announce a date when the tenders will be open, and then some selection will be done. Are you with me so far? All right. Now, therefore, that was a better treasury bill in the eyes of a critique, in the eyes of even the central bank, regular treasury bills. Now, I would be talking about the regular treasury bills because that what exists today. Ad hoc treasury bills, they have wind up. They don't exist anymore, because government realized after the reforms came in 1990s, it's just becoming too much of an indiscipline on our part, and RBI has been insisting that on government. You stop that ad hoc bill. It's unmanageable. Okay, how I cannot manage my accounts? Ad hoc bills have stopped. We now have only regular treasury bills, but there has been very funny thing about the regular treasury bills. Some treasury bills were on and off, and one has completely stopped. But I need to talk all of them a little bit to give you a complete perspective. And today in India, there are 4 categories of regular treasury bills. There are 4 categories of regular treasury bills in India. The 4 categories are this fellow here, 14-day, 91-day, 180-day, and 364, 182-day, 182-day, and 364-day. There are 4 types with 4 different maturities. The type is in terms of the term of the bill. They have used Government of India so far. Now, I am not talking about the British days, what they had. Reserve Bank of India was created during the British days. Then they were nationalized around 1949 or so. I am not talking about what kind of bills, government bills, treasury bills, British government used to use. I am not going to talk about that. I am talking about the post-independence period. Now, It's very interesting that the 14-day, the shortest bill, shortest duration, gone completely. They introduced that, completely gone. The two most popular ones are today 91 and 364, and the 182-day bill came in, went out for a while, few years, and then they came back again. So, I need to give you the data and want to tell you as to what happened. Okay. Before I go to the regular treasury bills, let me give you a history of the ad hoc bills. Indian banking system was very mature, and you can imagine the British government was also on its way out. So, India had to start everything afresh. They have to develop their systems. These ad hoc bills, however, which government of India used to use for a long time and extensively, these ad hoc bills were introduced in 1937 in Indian British period. All right. And they had a very interesting thing during the British period, and which continued after independence, that there was an agreement between the government and the RBI, a very interesting agreement, that if government wants ad hoc bills to be funded, financed through sale of ad hoc bills by the RBI, then government should maintain with the RBI an interest-free minimum cash balance of 50 crores on Fridays and 4 crores on other days. Because RBI looks at it from a banking point of view. RBI is the banker of the government. That as a banker, if I have to give you money, I need that your cash is with me, against which I will of course give you money. If you have nothing with me and the entire thing is going from my pocket, and again you are asking next week to give more money, it becomes very difficult. So, what they agreed, they started the agreement during the British days, and I guess those days there were no regular treasury bills, they had ad hoc treasury bills, that 50 crores on Fridays, end of the week, and 4 crores on any other day, there should be minimum balance. Whenever cash balance of the government will fall below this minimum, government would replenish the cash balance by borrowing from the RBI against the ad hoc bills. Ad hoc bills came into existence as something which would be floated whenever government is, say, overspending, and the minimum cash balance, their balance with RBI, which is their banker, is going down below a minimum limit. 50 crores on Friday and 4 crores on all other days. Whenever government's cash balance went, like you have some money in your account, whenever you overspending, you cannot keep that minimum balance, then you have to take the responsibility by selling bills, because by selling bills what is happening, government is borrowing from RBI to fill it up, and also government now has a responsibility to pay it back. And treasury bills are money market instruments, they are not like you take money for 10 years. Now, for 10 years to shanti hai, 10 saal baad dekha jayega. Aisa nahi hai. These are short term bills. So, ad hoc bills, I think ad hoc bills initially and was there when ad hoc bills were there, they were all 91-day bill. So far I have gathered from the literature, all ad hoc bills were 91-day bill. So, within 3 months it will mature. So, this was the beginning or the introduction of ad hoc bills, how it came into existence. Government has its account, like you and me have account with commercial banks, government has accounts with RBI, where there is some cash balance. For our savings account also we need a minimum cash balance, I think it is 1000 rupees. If goes down below 1000 rupees, there is a penalty. They would ask the depositor to pay a penalty. So, here RBI's penalty is, if it goes down below the minimum, is that government now you sell bills, borrow from us, fill it up, the gap, and when you are borrowing, of course, you have the responsibility of a debtor, you have to return the money. Okay? But this borrowing those days, RBI was also so poor that RBI most of the time was printing money, and there where it was getting unhappy, because printing money is something which a monetary authority does not want to do often. Because if it is a monetary authority, it has to control the monetary economy, and monetary economy, sometimes people say, earlier literature always said, these days also they say, is a very important determining factor of inflation in a country. So, if the monetary authority goofs up management of money supply, it can create an enormous amount of inflation. Later what happened? Even from the pre-independence days and later, they gradually, what they did was, RBI was borrowing so much of ad hoc money, and the ad hoc money, ad hoc bills were often deficit finance, which is created by printing money. What happened was, they started, this is not usually known as a money market instrument of the government, because they are not very short term. RBI advised and government agreed that they would sell what we know as bonds, and that what they introduced, but I am not going to talk about that. They are called government dated securities. It is essentially bonds, long term bills, 2 years, 3 years, 4 years, 5 years, etc. So, this is what they did, slowly introduced, but you can imagine central government, central bank was just beginning its business those days. In India, independence came, new government, the whole country is new. You have to start everything from the beginning, build the institutions. So, ad hoc bills went on for a while. Later, a substitute one was created, which I won't talk, but you will get these details in Bhole's book, Professor Bhole's book. Government dated securities, which are essentially government bonds, long term, 5 years, 6 years, 4 years, 3 years, whatever. But they are, if they are more than 1 year, we should not talk about that, because it is not part of money market. All right. Then some of you who have taken Indian economics, the planning era came, and you know what trouble we got into from third plan, third, fourth, fifth, enormous trouble in India. You learnt all that. Now, where is the money coming from? Therefore, government of India was in big trouble. So, it was immense strain on RBI to keep on funding government, because government balance was never 4 crores and that 20 crores. It was probably nearing zero often. So, ad hoc bills were extensively used. Finally, September 9, 1994, after this reforms, when the reforms started in India, Government of India and RBI entered into, after how many years then? 50 में plan शुरू हुआ, 44-45 years, they got into an agreement, the agreement again between Government of India and RBI, that we would now phase out ad hoc bills completely. No more ad hoc bills will be there. We will return all the money that we have borrowed from you against ad hoc bills by 1997-98. By 1997-98, Government of India promised RBI that we would phase out completely all ad hoc bills. So, they agreed upon various limits, how much intra-year and end of year they would have ad hoc bills during this period, which they can reasonably return, not more than that. However, what happened was, whatever government promised, government failed. So, when that miserably failed to phase out ad hoc bills, because government is still in trouble, financial trouble, and ad hoc bills are still important. So, what you are saying is, now you have to understand government finance position. Government dated securities are already known thing in the market. They are borrowing on a long term basis, which they do not have to repay immediately. They have 3 years to repay, 4 years, 5 years to repay. Then they have these regular bills are already known in the market, some of them at least, if not all of them. So, they are borrowing from the market. So, banks are lending to government, non-banks are lending, you and me are buying them, all right, and RBI is of course there. In addition, ad hoc bills were so important still, that means government of India was so much in financial trouble that they couldn't phase that out. So, in 1997, 26 March, a fresh agreement, they arrived at a fresh agreement to discontinue the bill from 1st of April 1997, all right. And all outstanding ad hoc bills and 91-day regular treasury bills on tap, I will talk about that later, were converted into a special security without specified maturity at an interest of 4.6% per annum. So, what they did was, finally they put a stop on ad hoc bill by not being able to repay the money to RBI, but by converting these ad hoc bills. And one more item, RBI 91-day bill on tap, I will talk about that. There were two kinds of 91-day bills were there. One was on tap, one was the auctioned and through tender, etc. So, 91-day bill on tap jo tha, plus ad hoc bills, they were all converted into some special securities of the government. Security means basically a bond paper or something, which would annually pay whoever bought them, either RBI or the banks or whoever have bought them or other governments. Government of India would pay them that same old interest rate 4.6%, which is ridiculous, big trouble. 4.6% is not good. They would pay them, and with any specific maturity. So, what it has become then? Ad hoc bills, you know, a term, a particular time or type of money market instrument. I talked about that in the beginning of first topic. Without maturity, they were converted into fixed interest bearing government security. What is it called? I have said, I have uttered a name, a word for these. England, for the first time, that was used in England in the 19th century or something like that. What are they called? Government converted them into special securities without any specified maturity. That means, government is not promising when I will return your money, the principal, but I will keep on paying a nominal 4.6% interest to whoever have funded me in the past when I sold ad hoc bills. This is what it is saying. Huh? What are they called? In perpetuity, yeah, in perpetuity of course, but what are they called? Yeah, consul. They were converted into a consul actually, which has no specific maturity. It will promise to pay you continuously, which often governments have done. England did that. When England was in trouble at one point, it sold consols where whoever bought them will get an interest rate, but there is no promise. This is not a typical bond, not a typical bond. Bond has a finite maturity period mentioned. No promise when they would return the principal or terminate that, close that. But it promises an interest rate which they will keep on paying to you. And this is what happened to the ad hoc bills. And one more thing went into that package as far as my notes go, what I have here. They are called 91-day bill on tap. 91-day, etc. I told you, they were all regular bills were sold either through auction or through tender, but there was a 91-day bill those days, which was, I have some data with me, not much. 91-day bill on tap. What does it mean? They are not announced anymore. They are available on tap. जब भी चाहते खरीद लीजिए, क्योंकि government के hard time रुपया ज़रूरी है. So whenever people had some extra cash, thought government bills are safe because it's part of gilt-edged market, risk-free, they would go and open the tap, basically ask across the counter, give it to me. Like the way we go and buy jam and butter and bread. They are always available. It's not the shop announces, today we are selling jam and butter, or another day it announces, today we are going to sell something else, all right, is always available. So on tap there was a 91-day bill, दोनों को ही बंद कर दिया, converted them into special securities with a fixed interest rate without maturity. Console, essentially console, they were converted into consoles, all right. All right, then the 91-day bill came, the regular bills. These are the discussions I need to have. And I have some information on this. It's quite interesting how Government of India funding process went.